This first slide just looks at the compounded annual growth rates of different asset classes, such as Bitcoin, which is obviously phenomenal, as you might expect, gold, S&P 500, NASDAQ, but we haven't included UAE real estate. There's a separate slide for that because, to be honest, it's quite an opaque market, although that's changing. But we do have some information which we'll show at the end, courtesy of John. So is there anything, Nicholas, you'd like to comment about this slide?
Well, first of all, it's for 10 years from 2021.
Compound,
compound. And secondly, I think the number looks pretty good up there, 196,000, but that's diminishing. So don't expect anywhere near that for Bitcoin. You're probably looking at anywhere between 25 and 40, depending on how you invest.
Davinci obviously might have a disagree about, but we'll come on to that. So there are, I promise you, just a couple of slides before we get on to questions. And the only question they're aware of, these panelists, is my first one, because I thought it'd be more fun if we just surprised them. So before we actually come on to some of these other slides, what would be interesting is just doing a quick poll. So let's imagine you won the lottery, $250,000, and you paid off all your debts, and you had to invest in one of these asset classes, Bitcoin, UAE real estate, or gold. If you just put up your hand, and then I'm going to ask you the same question at the end, and this will put pressure on the speakers to perform, because let's see if you can actually swing the audience as to where they're going to invest. So who, if they won the lottery, would invest in Bitcoin? If I could just have a show of hands. Okay, so that's a pretty good number. What about UAE real estate? Okay, slightly more in my opinion, about the same. And then gold, which is lower, okay, by half, I'd say. Okay, so don't be surprised if, Mona, you can remind me to ask the same question at the end. So let's just, before I open it up to the questions I have in mind, let's look at some other Bloomberg tables. So Nicholas, as you're the CIO of a family office, maybe you can touch on this.
So this is I just sent this last night. So these are the returns since 2020. And the reason I included this is you've had two bear markets. So it's looking at the impact of the returns if you'd held for 2.5 years roughly. Bitcoin's about 232,000. And then you've got the S&P 33 and gold at 24. And the reason it's interesting is a lot of people just buy and hold these things. So even if you got in at a fairly average time for Bitcoin, you would have done well. And I think the last 5 years has been unique in that we've had pretty much three bear markets, 18, 20, 22. So that's why I suggested quickly looking at this. And then the next slide basically looks at the returns since May last year. So obviously you can see that Bitcoin is negative 20. So I think what you get from this is timing is quite important. And knowing actually how to invest in each asset class is quite important.
Okay, what about the correlation, Nicholas, between gold and Bitcoin?
Yeah, so I didn't send you a correlation slide. Correlations change. At the minute, in the first quarter, Bitcoin was correlated to everything, S&P and gold. I think recently you've seen a counter trend in the last few months. The stock market's been rallying and Bitcoin has been going down. So correlations change. If anything, I would say it's probably been closer to gold in its first phase of growth and closer to stock markets in its latter stage. But the most important thing as an asset allocator, you want to add things that have the unique journey. So they're not tied just to one thing and they're constantly moving. And I think Bitcoin has proven that it actually has its own journey and its own benefits for correlation.
Great, thank you. Let's move to UAE real estate, because we all know that the palm, for example, has been booming, and it could be influenced by the 600,000 Russians that apparently have moved to Dubai in the last 12 months, which is quite a staggering number. I'm not saying they all moved to the palm, but the palm has increased dramatically. I live in Meydan. My rent's gone up crazy. So clearly the Dubai real estate market is having a boom. So maybe, John, you kindly provided this slide, and I know there's not much data available, but could you just try to summarize what the performance in the past has been for Dubai real estate residential?
Yeah, so this is the Dubai market as a whole, for the whole of the residential market. Sorry, the whole of the property market in Dubai from Property Monitor. It's just a 5-year graph. What we know about Dubai real estate is that it's obviously very cyclical. It has its ups, its downs, and it is maturing as we go. In the pre-financial crisis era, obviously there was a very speculative boom, and it bounced off. It had a big crash, as we know, and it bounced off that bottom. And that was the first phase of the market starting to mature. But there was still a lot of speculation. 2011, 12, 13, 14 was still quite speculative. Still quite a lot of money flowing in from the Arab Spring revolutions. And I'd say that was quite a speculative upcycle, although it did show signs of maturing. Obviously, from that previous peak around 2014, we went into a long-term decline into about the end of 2019. And there was many factors. I won't go into all of them, but there were headwinds, low oil price, there were rising interest rates, there were other headwinds that caused the decline of an oversupply of properties. 2014 was the largest year for off-plan launches, which I suppose makes sense because 2014 was the previous boom, so everyone launched properties into the market, and the market simply couldn't absorb it. Since 2020, obviously, we've seen very positive conditions, and I think we've seen a real change now. It's a structural change in the market. The market is now much more driven by end-user demand, and where it goes from here is anybody's guess, but I certainly can say that from my own experience, I can see a lot more end-user demand, people buying properties for the reasons that they were built. Much less speculation, although there is speculation, there's less than there was in the previous cycle. And I can see that there's a great future. It's still very well priced and very tangible on a global context. If you base it on where it's at compared to other cities around the world, it's very affordable. And if you also look at some parts of the market, you can see a lot of tangible value. You can still buy properties today in Dubai for less than the reinstatement value. So if you take some of the prime location buildings in a place like Dubai Marina, for example, if they were to be removed, knocked down, burnt down, whatever, and you started again, no developer would take the project on and try and build that location, that building, for the current price that these are trading for in the secondary market. Yet every developer would take it on and sell it for a lot more per square foot in the off-plan market. So that's where I still see great opportunity. It would sell immediately in the off-plan market for significantly more than you can currently buy it in the secondary market. And that's a big opportunity, and it shows that there's still a lot of tangible value.
Great, well, I appreciate that. What we're going to do now is make it a bit more controversial, or get more controversial as the session develops. So what I want to ask everyone, and this is the one question you are aware of, is what are the do's and don'ts of investing in these different asset classes? So why don't we start with Bitcoin and crypto generally. So this is for Davinci and Jeetu, as you're the two experts in that field. So maybe Davinci, I can ask you first. What are the, and sorry, welcome back, Andrew. I'll come to you in a minute. So what are the do's and then the don'ts of investing in Bitcoin, for example? What do you need to do?
Well, first off, right, many people buy Bitcoin from their friend of theirs or somebody they talk to on the internet. Don't do that. Go to an exchange, right? That's the worst thing. Worst advice is, or if you meet somebody who's messaged you on the internet and they pretend to be me or any of the influencers, it's 90% chance, 99% chance it's not one of us. We do not approach people and ask you for money. So that's the major mistake that people make with crypto, is that they trust somebody that just randomly talks to them on the internet. Don't do that. Next is just purchase it from the exchange and start with leaving it on the exchange for first if you're new to crypto, because even though you shouldn't leave it on the exchange, you want to start there and then take a small amount off and put it into what's called a hot wallet. A hot wallet is like a wallet on your phone or a wallet on your computer. Then later on, move on to using a hardware wallet such as Trezor, not Ledger, because Ledger is allowing you to take your keys off the ledger. And any hardware wallet that you want to have, you want to make sure the keys never leave the device. Why is that? Because then there's a question of whether or not they have enough security to protect your keys. You want to be the protector of your keys, not somebody else. So this way you will never have a question, well, did somebody steal my money? For example, Atomic Wallet over the weekend, had a major vulnerability, and 5 million people were hacked and lost all their crypto. This is a hot wallet, an example of a hot wallet hack. And so this is why hot wallets, although they're relatively secure, then there's no guarantee 100% that that's going to be as secure as, for example, a hardware wallet. So a hardware wallet is where you want to end up with to make a storage of the majority of your assets or crypto assets is in a hardware wallet, because it is separate from the computer system. All the key, which is where where you would sign the message to send the transaction, stays inside the device and never leaves the device. And that's important, because if that leaves, then somebody else can transfer the wealth from you. So that's the key thing, the difference between a hardware wallet, which is cold storage, and a hot wallet, which is on your computer or phone. So you have to learn these things, and take your time. Don't try to learn it all at once, right? Because you will make mistakes. That's another thing that people do. They try to jump into it and do everything, move hundreds of thousands of dollars all at once, even though they just got into this. And you can find, I've found lots of people who've made massive mistakes where they transferred the money to the wrong address and they can't get it back. This is like cash. This is like giving somebody a bunch of cash, and that's it. If they don't want to give it back to you, they're not going to give it back to you, and that's that. So you have to treat crypto like cash and be very careful.
Great, thank you. Jeetu, maybe for you, how do you go about selecting a platform? Obviously, after the FTX debacle, which everyone knows about, what checks can you do on a platform?
I'll continue with what Davinci told. You should buy it from an exchange. Why you should buy it with an exchange? We need to understand whatever, even if you're buying a real estate, we do our thorough research that which market I am getting, what is the location, which is the broker I am entering with. This is same with Bitcoin also. If you're buying Bitcoin, we need to research on the exchanges that how they are running their system. Why exchanges? First of all, there are centralized wallets and there are decentralized wallets. Exchanges majorly are centralized exchanges. And then we have a decentralized protocol in which we have different decentralized wallet where we purchase Bitcoins from our friends. But many times we don't know, because it is decentralized in nature. There are many addresses in Bitcoins which were used either in hacks or they were used for different criminal activities, which goes in the agency list. There are different agencies across the globe, and all these Bitcoin addresses are marked with them. And then there is a system which is chain analysis, and there are different companies across the globe which put all these addresses in their system, and these exchanges use these systems. Or for example, as in platform, we are running a global platform and it's a cross-asset trading platform. It's a traditional and crypto exchange platform. In that, we are doing a thorough research that what we did post FTX, this was not post FTX, this was 3 years back when we started our platform. We were very clear that we will not hold the assets. We will have a separate custodian, and that custodian will be the largest custodian who has history of last 7 years, not hacked MPC wallets, and we brought in them. Fireblock is the custodian we use. And not only for us, there was an exchange, for example, FTX. What they were doing, they were holding the assets, they were showing that the assets are in our wallet, but at the back end they were using for their operation systems. But when you work on the exchange, you need to understand that what is the custodian, are they keeping your assets on chain, on your wallet, or they are using at the back end. That is very important. So that's what we have done. We integrated the whole system wherein we can monitor each and every transaction, each and every asset coming on our exchange is cleared by all the agencies. That's why Davinci recommended that you go on the exchanges, because all the regulated exchanges, they need to compulsory integrate all these systems and they need to report any vulnerability with the authorities. So it is very important for us to do the research on which exchange we are going and what we are buying, how they are managing their compliance system, what are the corporate governance they are maintaining, and which are the licenses they hold across the globe.
Great.
That's going to be corrected, of course, with Bitcoin, because that destroys the fungibility of Bitcoin. If they say, well, these Bitcoins are bad and these ones are good, that's horrible. That's corrected with Taproot and Schnorr signatures, where the exchanges will not be able to detect whether the Bitcoin that's transferred to them is been tainted or not. They will not be able to do that as we slowly switch to Taproot and Schnorr signatures, because that destroys fungibility.
UAE real estate, what are the do's and don'ts? Obviously, first thing is check the broker is RERA registered, I guess.
Yes.
What else are the do's and don'ts?
The good thing about Dubai real estate is there's no hot wallets, no cold wallets, can't be stolen very easily from you. I've not really heard of
What planet do you live on?
I've not heard of people getting hacked and having their real estate sold
From the government?
without them knowing. But the do's and don'ts are, yes, of course, use a regulated broker. Use someone who is willing to give you maximum level of transparency. Use a broker who has access to all of the tools in the market that allow them to give you transparency. Let that broker invite you to their office or come and see you and literally show you all of the transactions that have taken place in your market. And be very comfortable that you are literally being shown everything that is happening in the market, and then let them explain why are some transactions up, why are some transactions down, and let them be a conduit to information for you to make your decision. Don't be sold to. And I think that's pretty obvious, but a lot of brokers will try and sell their idea to a client. What we say to all of our brokers is, you're not there to sell something to someone, you're there to be a conduit to information and transparency. Give them the tools that you have and let the client make decisions.
Andrew, you're obviously from the World Gold Council. I know your institution very well. You have gold ETFs, a lot of jewelers are members. So can you just summarize the do's and don'ts of investing in gold?
Sure. Well, I think the first thing you need to do is to determine whether you want an exposure to physical gold or a synthetic exposure. So a synthetic exposure would be gold futures, options. It could be gold mining stocks, things like that. Now, my comments are not going to be considering synthetic exposures to gold. I'm going to talk about physical gold. So that's the first thing you need to ask yourself. Do you want physical gold, a hard asset, or do you want a synthetic exposure to the gold market? So if you decided to invest in physical gold, and that could be gold ETFs, and I would say that gold ETFs, you do have to be careful because not all gold ETFs are physically backed, although most are. So our ETF, for example, is fully physically backed. And the other sort of physical gold products you could think about would be gold investment accounts, sometimes offered by banks, sometimes offered by non-bank financial institutions, or outright purchases of bars, coins, or even gold jewelry. But if you're invested in physical gold, you've made that decision, you then need to ask yourself or understand, is that product allocated or unallocated? And these are legal terms. And if the product is allocated, or if the gold is allocated, that means that you are the outright beneficial owner of the gold. A gold bar will have a serial number. You are legally entitled to that gold. So even if you hold that gold at a third-party institution, either a vault or it could be a vault that's managed by a bank or another custodian, as long as it is allocated to you in the event of a default, you have legal entitlement to that gold. It doesn't sit on the bank's balance sheet, it is yours. So that's the second sort of question you need to ask yourself. And then you need to think about, are you buying and holding for the long term, or are you trading? And that will determine your ticket size, that will determine which particular product you would buy. But then we need to think about, the rationale for holding gold. Yes, it doesn't provide the same returns that a lot of other asset classes provide. But it can reduce, and it does, if you look historically, it reduces your risk-adjusted returns of an overall portfolio. So we wouldn't advocate putting 100% into gold. That would be, or any particular asset. But what we argue is that gold has a strategic purpose in a portfolio, and that's to reduce your risk-adjusted returns. And if you look at over time, historically, it has been a major source of returns. It's outperformed all fiat currencies. It's an effective portfolio diversifier. So we talked previously about correlations, but if you look in the longer term, if you look at the 10-year average, for example, gold is not strongly correlated to any particular asset class. And I could talk about why a bit later on. The only semi-strong relationship really with gold is with US yields, and it's an inverse relationship, but it's not a pro-cyclical asset. So if you go back over the last 25 years and you look at major financial crisis, gold has outperformed other asset classes at those crisis points. And that's one of the reasons it's a safe haven. That's one of the reasons why you would think about an allocation to gold. And I think the final point I would make is it's highly, highly liquid. Over $145 billion of gold is traded every single day. The financial market size, or the size of the financial market for gold, is about $3.5 trillion per year. So it's a very large and liquid market, more liquid than US Treasuries, for example. So I think to summarize, I mean, the investment case, it is a source of returns. It's a portfolio diversifier, and it's a very liquid asset. You can easily enter and exit the market. It's less sticky than, say, property. And you could argue as well that digital assets aren't as liquid as well. I can send a link to the prospectus. The gold is held at JP Morgan and HSBC vaults. There's a bar list. There's a metals audit that takes place every single year. There's a financial audit. That gold is allocated to the AP, so it's there.
Nicholas, you've been very patient here. So what's your opinion about this debate, the do's and don'ts of what we've been discussing, gold, Bitcoin? As you're a CIO family office, what's your input to this?
So I think the reason that people buy a lot of real estate is it's easy to buy. It's simple. It's not complex. So buying Bitcoin, I'm sure there's a lot of people that have tried. It's actually quite hard. You know, opening an exchange account, sending your money to exchange. Do I keep it on an exchange? What's a hot wallet? What's a cold wallet? It's a lot to learn, and it's very confusing. And I get that puts a lot of people off. I wanted to buy Bitcoin back in 14. I went through the same journey. Oh, it's a Ponzi scheme. Then I realized bubbles and Ponzi schemes are wonderful things. You can make money from them. But it was too complex, and I found it too hard. So if you want to buy crypto and you want an easy way of doing it, and you just want to make some money, there are loads of ETFs and ETNs out there. You don't have to buy the physical thing. You don't need a wallet. You don't need to worry about all of it. If you have a Saxo bank account, Saxo investment account, Swissquote, Interactive Broker, you can go and buy an ETN.
But that's a bad idea because they don't actually have the Bitcoin.
That's a bad idea because they don't actually have the Bitcoin, which for me makes me sleep better at night. There's kind of two sides to it, and I fully get that. And I personally use exchanges, but it's not, it's my money. But for work, I use ETNs. I'm an asset allocator. I'm a technical analyst. I want to make money and I want to sell it. I don't want custody of anything, and I don't want responsibility of having money. I've got other CIOs that bought FTX stock, that had money on FTX. I've got the guys looking to Bitcoin. They had some friends. 100 million he had on FTX. 100 million. He's ex Special Forces, so I feel a bit sorry for Sam Bankman-Fried. But so you can buy an ETF, you can buy an ETN, ProShares. There's a short. You can short the market. You can go long times, 3 times. You can buy a basket. Leon Tech is a great product. You can get on Swissquote. You get a basket of 10, 15 cryptos. And then you don't need to worry about all of those issues. And then one other point.
If dollars is real money, then yeah, sure, it's a great idea, right? But that's all you're guaranteed is the dollar value.
It's all about investment and speculation, what we need to do.
Most of us actually, and I understand, so I've got my best friend and business partner, I have a crypto project on the side. He only thinks in Bitcoin and Satoshis. That's how he measures things. I measure things in dollars. But everyone's different, and I think most of us probably use dollars. But going back to the other point, real estate can be seized at any time. Russia is a good example. It can be seized, and don't think it can't. And we have money in banks, and our banks, for example, no longer do business with NRAs, non-resident aliens in America. So I have hundreds of thousands of dollars that now we have a manager's check, which we can't put in the bank. So there's a lot of pitfalls to everything.
Gold can be seized at any time. Bitcoin can be seized at any time. Laws can be made at any time that outlaw anything. But the question is like in Germany, for example, gold. It was outlawed that you couldn't own gold, physical gold. And the US. Yes, and the US, exactly. So the question is, are you going to abide by the laws in the country in which you live or not?
That's the problem.
Your freedom can be seized at any time. So, but I'm talking about these different asset classes in a world that doesn't take in these huge, these big examples of literally being locked up for the rest of your life for owning a certain asset. And my question, though, is you obviously mentioned that the reason that people buy real estate rather than Bitcoin is, well, real estate is simple, everyone understands it, whereas Bitcoin's pretty complex. But I would say, is it not also the case that real estate as an asset class has intrinsic value that is pretty easy to forecast what's likely to happen? Nothing's certain, but it's easy to forecast what's likely to happen, whereas Bitcoin, how can you forecast? I can, for example, say if you buy a bit of real estate today, and let's say it doesn't go up in value. Let's say it goes down in value. Both capital value and rental value go down. Let's say we're not in an inflationary environment of 2% per year. Let's say we go into a deflationary environment of 2% every year for the next infinity. For the next 20 years, 25 years. Real estate on a total return basis at today's yields will give you a positive return. Who knows what would happen?
And let's bring out a crystal ball and try and project. I see some unregulated businesses here launch high yield products guaranteeing 18%. I think they're in the Burj Khalifa, no names because I don't want to be sued. So let's look at what the returns could be from these different asset classes. And we'll start with Andrew in Singapore. So I know you can't always talk about the gold price and forecast, but what's your opinion about where gold could go, Andrew, in the future?
We don't forecast the gold price, but you need to look at the sources of demand for gold. So about 40% is jewelry, and that tends to be pro-cyclical. So that's the large markets of India and China. So growth in India and China, that is a large part of demand for gold. But the previous speaker from the property market was really talking about the utility of the asset. And about 10% of demand for gold is technology demand. So it is used and has real world utility, and that's also pro-cyclical. But then you have central bank demand, which is about 20% per year on average, and the rest is investment demand. And they have very different drivers. So investment demand drivers for gold, it's about economic uncertainty, it's about inflation, it's a counter-cyclical demand. So this means that gold performs very, very differently from other asset classes because you've got both pro and counter-cyclical demand. You've got huge diversity of demand, and you also have very different geographical diversity. It just means that gold performs very, very differently to other asset classes. But because it performs differently to other asset classes, that makes it an effective portfolio diversifier. So the reason for investing in gold is not necessarily to make tons and tons of money, or you can do that. It's to improve the risk-adjusted returns of your overall portfolio, because the evidence shows that a strategic allocation to gold, and we're talking of anywhere between 5 and 15%, does improve your risk-adjusted returns. And that's why central banks will allocate to gold as a reserve asset. They're certainly not allocating to crypto or digital assets. They're allocating to real assets like gold. That's why institutions like pension funds, for example, will allocate to gold, because it can improve your risk-adjusted returns whilst also lowering your volatility as well.
Great, thank you, Andrew. What we'll do now is touch on real estate in the UAE, then we're going to come on to Bitcoin. So what's your forecast for real estate here in the UAE over, let's say, the next 1, 3, 5 years?
So I'll get to that in a second, but I'd just like to say, in return to what Andrew said, I completely agree actually with everything that Andrew said. And I personally don't see it as a gold versus real estate conversation. I've personally been a big fan of owning 5% of my portfolio in gold for the exact reason that Andrew's mentioned, which is it's a great way to rebalance during downturns. Obviously, if you look at what happened to the stock market around the COVID period, owning gold was a great opportunity to have a liquid asset that you could rebalance out of that and take advantage of the depressed values in, let's say, the S&P 500 at that time. But I would personally only ever want to own a minority of my portfolio in gold, whereas I would be quite happy to own quite an overposition or a majority of my portfolio in real estate. In terms of where the real estate market is going to go in Dubai over the next 5-10 years, to be honest, we're not in the game of trying to forecast the market. We're not in the game of trying to, from an investment point of view, say it's definitely going to go up or it's definitely going to go down. What we would rather look at is what are the sort of key aspects of the market for consideration. One thing that I think is interesting to look at is that, like I mentioned earlier, the tangible value is still very much there. Andrew, yourself, you coming from Singapore, I hear, as many people who come here from Singapore, we have many clients moving from Singapore, and they are all amazed at the value that they can get, the lifestyle that they can get. When they look at properties to live in, they are amazed at how much more space they can enjoy here in this city compared to where they have previously lived. And that's the same when people come from New York, when they come from Hong Kong, London, Paris, and many other cities. So Dubai is still a very, very tangible market, and people moving here for all their own reasons are finding that there's still great value. Like I mentioned earlier, there's still tangible value in certain areas where it's below the reinstatement cost, what a developer would actually put capital to work to build, and they could sell it in the off-plan market. So there's that disconnect which creates opportunity in my mind. I think there's some tailwinds to consider. We've had the headwinds of rising interest rates over the last 12 to almost 18 months now, and we've got through that as a market quite well. Now, I think we're going to start experiencing some tailwinds. We're maybe not at the end of the rising interest rate cycle, but we're certainly much closer to the end. Is there going to be another rate hike in a week's time or not? That's anybody's guess. But what we've found now, which is already acting as a tailwind, is as we move towards the end of the interest rate hiking cycle, buyers in the market are feeling more comfortable and confident, and banks the same, that they can start being a little bit more aggressive with the debt that they do take on. For example, at the early stage of the rising cycle, people wanted to take a 5-year mortgage, fixed rate. They'd pay a premium for a 5-year fixed rate mortgage to have the certainty of 5 years in a very uncertain period of time. Now, whether there's going to be another rate hike or another one, or there's going to be a pause, whatever the answer there is, a lot of buyers now are feeling like they're comfortable to take a 3-year fix, the cheaper 3-year fix. So as they move down the term, as they feel comfortable sort of in a risk-weighted way coming down that term, they are getting a more affordable product, which in relative terms is making the cost of that mortgage feel more affordable. At the same time, the banks have become way more aggressive with their margin. For example, 6 months ago, you would have got a 3-year or a 5-year fixed rate mortgage in Dubai for a lot more. It would have been a much higher rate than it is today. So even as we've had further rate hikes out of the Fed, we have seen that the banks are taking a hit on margin to keep the market going and to keep money coming into the market. For example, a 3-year fix today is 4.24%. 3-4 months ago, it was 4.69%. A 5-year fix 6 months ago was 5.5%. Now you can get it for 4.5%. So even though we've not got to the end of the cycle yet in terms of rising interest rates, we're already seeing the tailwind of what might be a lower interest rate environment in the years ahead.
Okay, sorry to cut you short. It's good stuff. And now let's talk about Bitcoin and any other coins. So this is to you, Davinci, then Jeetu. So what's your forecast for Bitcoin and maybe some other coins?
Okay, well, our Bitcoin will become money. So its valuation will be determined by what is the value of all the money that we currently have today against Bitcoin. So basically, you can see that Bitcoin will be a massive valuation in the future. Why is that going to happen? How is that possible? Because our current financial system is a fraud. Now, whether you believe it or not is irrelevant. Just because you could have invested in Bernie Madoff's fund at the very beginning and not know that it's a Ponzi scheme, but it didn't mean it wasn't a Ponzi scheme. Our current financial system is a scam against everyone because you could print money and buy a house. You're like, what? I can print money and buy a house? Yes, you just go to the bank, sign on the dotted line, and you just created some money. That's our financial system. That's how it works. That's why you see housing, real estate go up in value all the time. Eventually, that's going to come to an end. And houses are going to come down to the real value. What is the real value of a house? It's how much you could save, work, save, and pay for it. That is the real value of a house, not these inflated prices that we see today. That's going to come once our financial system ends. So you do not want to treat your house as a piggy bank. You will get wiped out. Absolutely. I'm not saying that real estate is a bad investment. You could still make money with real estate if you do it properly, but 90% of you guys are not going to do it properly. Only a small 10% of the population really understand what they must do with real estate in order to actually make it profitable, even if our system collapses, because there is a way to deal with it. One is you borrow against it, right? As the price goes higher, you take out your equity all the time, and you pay you get somebody to rent the property and use that to pay the mortgage. That's the proper way. Other than that, you should not be owning real estate.
Okay, so
Bitcoin
Can you make a forecast? Like, where would you expect Bitcoin to be at the end of the year and maybe in 10 years' time? Because people come out with some crazy predictions. I know you're probably
here's the thing.
sensible with yours, but
I told people when I bought at $1, I was buying at $1, $2, $3, $4, $32 at the top. That was the top in 2011, and it dropped all the way back down to $2, and everybody was laughing at me. So did I make a mistake? Would you agree that I made a mistake to buying it at the very top at $32? Obviously not, right, today. And I told them that it was going to be like well over the price of gold. And people laughed at me. And now I'm going to tell you it's going to be in the millions of dollars. And in fact, you won't even bother measuring it in dollars, right, one day. So if you want to know the prices for next year, this year for next year, it's irrelevant if you're buying and holding.
How much money has actually been invested in crypto? Because it's not very much. Estimates suggest about $200 billion. That's the first question. My second point is, I think we also need to think about the regulatory risk. The regulatory regime for crypto or digital assets has not been settled. In China, it's banned. The US is looking at SEC. It's an evolving situation when it comes to the regulation of crypto assets. And I guess the question would be, should crypto be regulated? Would that not make it more mainstream? Because one of the best things that has happened for the gold market is that when the restrictions were lifted in 1971, and then post that, having an equity wrapper on gold opened it up to huge institutional investors like pension funds. Mainstream investors could finally access the gold market. And that was partly because of regulation. And I'm just wondering whether you would argue for your crypto assets to be consistently regulated globally.
No, regulation is only protecting large institutions from competition. Why is Binance and Coinbase being sued when banks have done way worse, right, than any of these exchanges have done, right? So it is just protecting, the SEC is protecting the ingrained institutions such as JP Morgan, Bank of America, and so forth. That's all the regulation does, is protects the upper echelon of the corporate ladder. So basically, I do not agree with the regulation. It should be a free-for-all, and regulation comes from the individuals actually making mistakes and going, oh, better not do that again.
Absolutely, I agree. And I agree on the bank that there was a bank which went down recently, which was a Silicon Valley bank, which lost billions and billions of dollars. And the news was that it was a bank which was facilitating cryptos. But the actual reason, if you study, it was not because of cryptos, but it was because of their over leverage on the bonds, what each and every bank is doing. And when this bubble bursts, I think this will be much bigger scam happening than what has happened with FTX or any other exchange in past.
My question, I guess for the two cryptocurrency people in the middle there is, what it comes. My question kind of remains: what's the purpose of an investment? Are we hoping to buy crypto now? And I own crypto, that eventually this is the currency that we are going to use? Or is it a means of making money and speculation? Because then, as a person with social media following, you can just kind of do what Elon does and pump some shit coins and meme coins and make so much money and then dump it and live a nice plush life. So what is the main reason for investing in crypto? Is it that this eventually will become currency, or is it supposed to be a profitable investment?
It can be both, right? But I suggest people who are not really into crypto or just new to it to stick with Bitcoin, stick with Ethereum, the main ones. Obviously, I can't pump that, right? So because those are the safest cryptocurrencies out there. Again, you can go and speculate in all the other what's called shit coins, right, that are out there, right? But and there you will see huge return on profit, but it's very highly risky, right? Because you don't know which one's going to do well. which one's going to give you a 10x, which is going to give you a 100x in a very short amount of time. So I don't suggest that for the majority of people to get into any of the altcoins or low volume coins, because you could lose everything.
I will continue on this.
Yep.
We are comparing an asset class which is real estate, gold and Bitcoin. If we do the math, we are sitting on real estate, which is $300 trillion worth of asset class across the globe since ages. 60% of the total global wealth goes in that. We are on the gold, which is $13 trillion, and we are on the Bitcoin, which post-pandemic has grown at least 10x in terms of value, which was at $50 billion in 2019, and now we are at $560 billion as an asset class. If we compare the overall growth of Bitcoin in the last 13 years, going from 0.1 cent to $70,000, we have shown the history that how the asset class have outperformed each and every asset class. If we compare that, why Bitcoin went 10x in post-pandemic? Because there was a massive transformation and people understood that we need to diversify our investments, and they have done that. If we look at Africa, Nigeria, for example, 33 million users post-pandemic have onboarded on different exchanges and trading on cryptocurrency. Why? Because they don't believe in fiat system. This is happening across the globe right now. And what I feel, even maybe 5% of total real estate and gold asset allocation comes into Bitcoin and other asset classes. We are not looking less than maybe $5 million each Bitcoin in coming 20 years, which will outperform each and every asset class in last 20 years.
Knowing that we are approaching rate hikes, whether we pause or we have one more rate hike and then we are going to stop all that, my question is for Andrew. Don't you think historically gold has been growing exponentially? Like since 2000 till 2022, I guess gold has grown around 500%. Don't you think gold, after every rate cut cycle, gold grows 100, 200 and 300% up? Don't you see that coming as well? So not only is gold good for diversifying your portfolio for risk-adjusted returns, but also don't you think it's probably yield producing right now asset class that we could actually gain from the capital gain from gold?
Yeah, I mean, it's a good point. I mean, the major headwind for gold is US interest rates. But when we've looked at our research, and it's at the beginning of a Fed tightening cycle that has the biggest impact on gold's attractiveness and therefore performance as an asset. And so as it becomes priced in, as those interest rate hikes become priced in, their impact on gold's performance tends to diminish. And I think we're heading now towards the end of that cycle. And certainly our forecasts are that investment demand, particularly institutional investment demand, and I wouldn't write off institutions. Pension funds, they're managing people's money. They're managing the retail sector's money. It's not some opaque institution out there. They're managing real people's money. So it is really important to think about that. But to answer your question, succinctly, yes, as those interest rates become priced in, as we start to taper off, and the indication is that we're heading into that territory, that is usually very supportive of the gold market.
Andrew, do you agree that 80% of the gold reserves doesn't come in the market, what are mined, just for the price control?
There isn't a price control. I mean, about 50% of supply.
And
so
in total,
just
how
going
much
back
gold is there under the earth? Do we have any calculation?
So I didn't catch
How much gold we have, total reserves of gold under the earth? Do we have any calculation?
You could look it up, but...
No, that reserves of gold changes as technology changes, but on average, gold supply grows at about 1.5% per year. Demand always outstrips supply of new gold. So about 50% of demand is met through mine supply, 50% is met through recycling. And that's what makes gold very unique. Because
it works same as fiat systems work, the way dollar works.
Okay. What we're going to do now
because it's a physical asset. You can't print gold. It's a physical asset.
But we don't calculate that how much gold will come out in coming 50 years.
Yeah,
we know about Bitcoin that they are 21 million.
But hold on. Okay. We do know what we average on the increase in gold is about 2% which remains about the same, equal to the population. It's
1.5%.
Yeah.
1.5%.
Anywhere between 1.5% and 2%.
It's interesting to me that there is such diversity of views here. I want to contend, perhaps this is probably a question to the traditional asset members of the panel, that actually the distributed ledger technology, the basis on which cryptos have been launched, actually represents a huge opportunity for a greater participation and new capital markets for those assets. My concern with crypto today is that the utility of crypto has not yet become effective in any way. Bitcoin isn't actually used as a currency. Most other coins are not used for the gas fees to drive transactions on the underlying protocols in the manner that they were intended. So there is a lot of sentiment coin aspects of that. But I'd be interested in the views of particularly the TradFi kind of or traditional asset members around how is the future of your industry going to involve the use of this technology, of which crypto has been a great first use case, to drive your industry forward.
I'd like to answer that question because
before you do, because I want it to be split between all the panelists. So Nicholas and then Davinci, yeah?
You talked about targets. Price targets.
No, this gentleman's.
Your question. Sorry.
Yeah, and then Davinci.
Yeah, I think most things will be put on a ledger, and there's a case for it. You're right. Half of the coins out there you just don't need to run the transactions. You just don't need them. They're just there as an added bonus. But I think gold will go on there. I think real estate will go on there. I think everything will be on a blockchain, a digital ledger of some kind, whether it's your passport, your ID, your credit profile. So yeah, there's a huge market. It just hasn't, it takes time.
Question is, what's the use case for Bitcoin? It's going to be money. Now you're saying, well, it's not money now. Well, you could say, well, electricity, when we first invented it, the use case was, to light up our house, and that's it. Well, and there was no way to transfer that electricity to the cities because at the time they were using DC electricity. And in order to get that electricity to the cities, you'd need a cable the size of a bus in order to do that. And so people were saying, well, that's going to be useless. That's a fad. And yet today we all have electricity. And we use it for more than just lighting up our house. The same is going to happen with Bitcoin. You're going to use it more than just money. And it already started with ordinals adding to the Bitcoin protocol. People are creating their own tokens, their own NFTs and so forth on the Bitcoin protocol. But it will be used as money, but just, it takes time to adopt that.
Using the distributed ledger technology, the blockchain, to allow more capital to flow into traditional asset classes, I totally agree with you that real estate will start to become sort of securitized and there'll be tokenization of ownership. I don't necessarily think that's a good thing because, again, it increases capital flows into an asset class that is ultimately there to perform a purpose, which is to house people. So if it creates, much more expensive property, then it actually is not very good for social stability within a country. So I reckon if that does happen, it will be regulated, as you're seeing in places like, I think, is it in Singapore, if you're a foreign investor, you get hit by like 30+% or 60% now, I think. So it's not necessarily a good thing, but I do think that's the way it will go. And if it does go like that, then in a place like Dubai, where you've got gross yields at 6.5%, 7%, I think you'll see yield compression. You'll see yield down, price up. And that's probably not a good thing for Dubai, but it's good if you own real estate.
Now we're discussing what's the best alternative asset class, real estate, Bitcoin, or gold. But a few years ago, Bitcoin or any other crypto was not even taken seriously, right? Sure. So even Jamie Dimon, like CEO of Chase Bank, I remember
that the same word, what yes. JP Dimon told in 2019.
Exactly. And Jamie Dimon, for example, was saying that crypto is a scam and he will never provide crypto, to his customers. But now we know that for high net worth individuals, he provides asset management, including crypto and Bitcoin. So do you think, rather than, discussing what's the best, which is kind of clear, but do you think there could be a symbiosis between Web3 and Web2 and commodities? And for example, we can tokenize gold, right, for more liquidity, or Bitcoin or other crypto can support real estate, and amplify, so there could be symbiosis, I believe.
Very good question. I'm going to give Andrew first dibs. So Andrew, and then we'll open it up.
Thanks, Nigel. I actually think they're all complementary. It shouldn't be gold versus crypto versus property. They all have very different roles in an investment portfolio. I don't think anybody would say put 100% of any of your assets into one particular asset class. They're complementary. We would say crypto, it has a role to play. For sure, it's grown exponentially. People are embracing it. It's probably going to be embraced even more in the future. But it's not true to say it doesn't have risk. There are risks associated with it. It can be a volatile asset. The regulatory regime hasn't been settled. You do have counterparty risk. We've seen that through frauds. And that's why I would argue it shouldn't be a free-for-all. You should have regulation, particularly when it comes to consumer protection. Maybe the asset class isn't regulated, but the institutions that are offering it perhaps should be, because there's been a huge amount of scams involved. What we're saying is, so if you allocate to crypto, fine, it plays a role, it has a role in portfolios. You might want to mitigate some of that and balance your portfolio with an allocation to gold. So I don't think it should be antagonistic. We're really complementing each other in terms of the roles that the different asset classes play in a portfolio.
Yep.
Can I add to that
You
question?
can have the final word,
okay.
and then we're just going to ask where you might invest your money.
What's an alternative asset? Everyone says it's an alternative asset. So I run a family office. It's a bit like an endowment fund. So if you look at Yale and Harvard, it's a similar model. Alternative assets for us are bonds. We have 3% in bonds. Real estate is the biggest part of our portfolio. Venture capital, biggest part. Equities, gold, cryptocurrency. Alternative assets, I don't class them as alternative assets. They make up your portfolio. Most people in this room, their biggest asset is real estate. So I think we've got to flip the script a bit. I mean, alternative assets should be bonds. Why do we own bonds?
That's for another debate, so thank you.